Welcome to the Deep Dive. We've got quite a bit to unpack today. We're looking at YS Bank's latest numbers, the unaudited results for Q2, and the half-year ending September 30, 2025.
That's right. And this isn't just, ticking boxes on earnings. It feels more like a checkup on a bank that's been through a massive transformation.
Exactly. A real health check.
So our mission today really is to go beyond just the surface numbers. We want to understand if the turnaround plan, all those efforts from the last few years, are actually building something sustainable.
Sustainable is the key word.
Yeah. We need to look at the core metrics profit, how good the loans are, any big strategic moves, and see if they're genuinely heading towards that big goal they've set.
Which is that 1% return on assets target. That seems to be the North Star for them.
Precisely. That 1% ROA. Okay, so let's dive into the current results. Profitability first.
Sounds good. The headline net profit for Q2 FY26 came in at INR 654 crores. That's up 18.3% compared to last year.
Which, on the face of it, sounds all right. Respectable.
But you were saying there's a bit more to that story, an adjustment we need to make.
Exactly. You have to kind of peel back a layer. That 18.3% is fine, but last year's Q2 had this one-off income tax refund.
Ah, okay. Not something that happens every quarter.
Right. So if you normalize for that, if you look at the underlying sort of repeatable profit growth, it jumps significantly. We're talking closer to 30% year-on-year growth for Q2.
30%? Wow. That's a much stronger signal.
It really is. That's the number I think you should focus on. It suggests the core business is genuinely gaining traction, real momentum.
And does the operating profit back that up?
It does seem to. Operating profit hit INR 1,296 crores. That's a big jump, up 32.9% year over year.
That's substantial.
And even if you adjust for, swings in treasury income, which can sometimes cloud the picture.
Right, those can be volatile.
Exactly. Normalized for that, operating profit still grew a healthy 31.8% just from the previous quarter. So quarter-on-quarter momentum looks solid too.
So profits are up, operations look strong. Right. But are they efficient? Are they controlling costs while they grow? That's crucial for the ROA goal.
Absolutely. You need income growing faster than expenses. Looking at the cost-to-income ratio, the CI ratio, it held steady compared to the last quarter, around 67.1%.
Okay, stable's good.
But what's really interesting is how tight they kept the reins on actual spending. Operating costs actually fell 4.2% compared to Q1.
Fell. Quarter on quarter.
Yes. And year on year, they were only up a tiny 0.6%. Even while, business volumes are clearly increasing, that shows they're getting more out of their existing setup. Good leverage.
Okay, that cost control is impressive. Let's talk margins then. Net interest margin, NIM. That's the core profitability of lending, right?
The absolute lifeblood. INIM was flat compared to Q1, sitting at 2.5%, but importantly, it's up 10 basis points compared to the same quarter last year.
So slight improvement year on year. And management feels this is the bottom.
That's the commentary, yes.
Yeah.
They seem pretty confident that NIMs have bottomed out now. They expect it to expand going forward.
What gives them that confidence?
Well, two main things, really. One is the ongoing repressing of deposits, getting better rates, and the other is gradually getting rid of some high-cost mandatory deposits, which we can touch on more.
Got it. And the other income stream, fees and commissions, non-interest income.
That provided a really nice boost. It came in at INR 1,644 crores, up almost 17% year on year.
And what drove that?
It looks like core fees were the engine, up over 18% just since the last quarter. Things like foreign exchange services, loan processing fees, selling third-party products like insurance or mutual funds.
So the fee machine is definitely humming along.
It is, and that's important, right? It makes their income less dependent purely on lending margins. Diversification helps manage risk.
Okay, strong profit story, especially normalized. Let's connect this to the balance sheet. You need good, cheap funding to make those profits stick. How did deposits look in Q2?
Deposits looked exceptionally strong, actually. Total deposits hit nearly INR 2,096,276 crores.
Almost 3 lakh crores.
Yeah, and the growth was robust. 7.4% quarter on quarter, almost 7% year on year. Management made a point of saying this growth was better than the industry average.
Which, for a bank that went through what Yesi Bank did, that's a pretty significant signal of returning confidence.
Absolutely. But it's not just the total amount, it's the quality of those deposits that matters most. We need to look at CASA.
Right. Current accounts, savings accounts.
Yeah.
The cheapest, stickiest funding.
And this, for me, might be the standout number on the funding side. CASA deposits grew 12.5% year on year.
12.5%. Strong.
Very strong. And that pushed the overall CASA ratio up by 90 basis points just in the quarter to 33.7%.
So over a third of their deposits are now low-cost CASA.
Exactly. And if you drill down into where it's coming from, it's the retail side. Deposits from retail customers in branch banking grew almost 14% year on year.
Okay.
And within that retail segment, the CASA ratio is even higher, almost 40%, 39.6% to be exact.
So that really shows people are starting to use Yes Bank for their everyday banking, not just parking money for high interest.
That's the implication. It suggests growing trust and primary banking relationships, which is exactly what they need to lower their overall funding costs and help those NIMs.
Makes sense. So they're pulling in this good quality funding. Where are they lending it out? What's happening with advances?
Advances also cross a milestone just over INR 2.5 lakh crores.
Okay.
Growth was decent, 3.8% quarter on quarter, 6.4% year on year. But the interesting part is where the growth is coming from now.
Seems like there's been a shift.
Definitely. The main engine now is clearly the retail segment. Disbursements, so new loans given out to retail customers, jumped nearly 20% just in Q2 compared to Q1.
20% quarter on quarter in retail loans. They're really stepping on the gas there.
They are. It seems like a deliberate move to re-accelerate retail lending. It tends to be higher margin and spreads risk across many small borrowers, but they're balancing it too. Commercial banking loans also grew solidly, up 16.5% year on year.
So mix, but with a clear focus on retail acceleration. Now, you mentioned earlier about running down high-cost balances, helping margins. This ties into liability optimization, right? We saw borrowings drop quite a bit.
Yes, significantly. Total borrowings were down over 20% compared to last year and down almost 7% just since the last quarter.
Why such a big drop?
It's mainly tied to reducing those deposits they were required to hold because of earlier shortfalls in priority sector lending, or PSL.
Ah, the RIDF deposits. Rural Infrastructure Development Fund.
Exactly, those kinds of mandated, often higher cost deposits. They used to be a big chunk, like 11% of their total assets at the peak. Now they're down to just 7.8%.
So as those expensive liabilities mature and run off.
They don't need to replace them with equally expensive funding. They can use the cheaper retail CASA flowing in. It directly reduces their interest expense, which flows straight to the bottom line, boosting NIM.
That's a classic turnaround play.
Yeah.
Swapping out expensive wholesale or mandated funds for cheap retail deposits.
Textbook. And importantly, while doing this, their short-term liquidity looks fine. The liquidity coverage ratio, LCR, averaged over 125% during the quarter, which is comfortably above the requirement.
Okay, so the funding side looks strong. The lending mix is shifting towards retail. Let's pivot to asset quality. This is where the legacy issues really lived. Are things finally stable?
Stability seems to be the word. The headline gross non-performing asset ratio, GNPA, was flat. Flat quarter on quarter, flat year on year, holding at 1.6%.
1.6%. That feels manageable.
It does, and the net NPA ratio, which accounts for provisions, was also flat quarter on quarter at just 0.3%. That's really quite low now, down 20 basis points from a year ago.
0.3% net NPA.
Yeah.
Impressive. But are they putting enough money aside? What about provisions?
They're continuing to build the buffer. The provision coverage ratio, PCR, climbed further to 81%.
81%.
Yeah, up significantly from 70% just a year ago. So they're covering a much larger portion of the gross bad loans.
And are fewer new loans going bad? What about slippages?
That's another positive sign. Gross slippages, the new loans turning bad in the quarter, were lower. They fell to 2.0% of advances, or about INR 1,248 crores.
Down from
2.4%, or INR 1,458 crores in the previous quarter. So the inflow of new stress seems to be reducing.
Any other signs of cleanup? Restructured loans?
Yes, the standard restructured book is also shrinking, down to just INR 271 crores, which is barely 0.11% of their total loans. Very small.
Okay, so less new stress, shrinking restructured book. What about getting money back from old bad loans? Recoveries?
They recovered or upgraded about INR 854 crores in the quarter. Importantly, INR 220 crores of that came from the old security receipts, the SRs.
Ah, the SR book. That was the big legacy headache. What's the final status there?
This is a huge milestone, really. After these latest recoveries, the net carrying value of that entire SR book is now NIL. Zero.
Zero. So it's completely off the books in terms of potential future losses?
Effectively, yes. They've fully accounted for any residual value or loss. That specific source of legacy risk is now extinguished from the balance sheet. Done.
That must be a massive relief. internally and for investors, just closing the door on that chapter.
Absolutely. And speaking of closing old chapters, they also confirmed they redeemed those green infrastructure bonds issued way back in 2015 to the IFC. Another loose end tied up.
Okay, bit by bit, the past is being put away. Now let's talk about external validation. The numbers are one thing, but what are others saying or doing? Big news on the shareholder front.
Huge news. Sumitomo Mitsui Banking Corporation, SMBC, is now the largest shareholder.
Japan's SMBC.
That's the one. They bought shares mainly from SBI and others who came in during the 2020 rescue, acquiring a total stake of 24.22%.
Wow, nearly a quarter of the bank. That's not just a small bet.
Not at all. That's a massive strategic investment, a real vote of confidence from a major global bank. It suggests deep belief in the turnaround and the future strategy.
And the RBI doesn't classify them as a promoter.
No, the RBI clarified they are not technically a promoter, but their influence is clear. They already have 2 nominees on the board of directors, bringing that international expertise.
That's significant strategic backing. And seems the rating agencies took notice too.
They certainly did. Almost immediately we saw upgrades. Both India Ratings and CRISIL lifted their long-term rating on the bank.
To what level?
Up 1 notch to AA- from A, with a stable outlook.
AA-.
Yes. And the bank highlighted that all the domestic rating agencies now have them at AA-. That's stated as the highest rating level they've had since the crisis began back in March 2020.
And that rating matters, right? It affects their borrowing costs.
Directly. A better rating means they can borrow money more cheaply in the wholesale markets. It also increases trust, especially among corporate clients. It's a virtuous cycle.
They're also expanding physically.
Yeah.
Opening new branches.
Yes, signaling growth intentions. They opened 43 new branches in the first half of this fiscal year. They're aiming for 80 new branches for the full year.
And that ties back to gathering those retail deposits we talked about.
Absolutely. More branches, more visibility, easier access for retail customers. It fuels the Sankasei growth strategy directly.
Okay, so strong results, major strategic backing from SMBC, highest ratings in years, expanding footprint. It sounds very positive, but we have to address the main risk that's still lingering, don't we?
We do. There's still the ongoing legal case concerning the write-down of those additional Tier 1 or AT1 bonds from 2016 and 2017.
Right. The Bombay High Court had ruled against the write-down back in January 2023. What's the latest on that? It went to the Supreme Court, didn't it?
It did. The bank itself, along with the RBI and the central government, all filed challenges, special leave petitions, or SLP against that high court judgment.
So the regulator and the government are aligned with the bank's position in the Supreme Court.
Correct. The Supreme Court had previously put a stay on the high court's order, basically keeping the write-down in effect for now. And the next crucial hearing is scheduled very soon.
When is that?
October 29th, 2025, so just around the corner.
Okay. That sounds like a potentially significant event. How is the bank accounting for the risk that the court might rule against them? Is there a provision?
This is tricky. It's what's called a contingent liability. Because the RBI and the government are supporting the bank's case, the management's current assessment is that there's no material financial impact that needs to be booked right now.
So no provision for now based on the authority's stance.
Right. But they do acknowledge, obviously, that if the Supreme Court ultimately rules against the write-down, they would have to account for that financial impact in the future. But for this reporting period, they view it as a managed legal risk, not an immediate financial hit.
Understood. And briefly, they also mentioned the shift to new accounting standards for loan losses, ECL.
Yes. Expected credit loss accounting. It's a big change for the whole industry.
What's their take on the impact?
They're being cautious, saying it's a bit too early for final numbers. But importantly, their current feeling is that they don't expect a major negative shock to their opening balance sheet from their existing loan book when they switch over.
No big hit expected from current loans.
Seems not. And they even hinted they might get a small benefit from restating the security receipts book under ECL, given its carrying value is already nil.
Interesting. Okay, so pulling all this together, quite a quarter.
Oh.
How should you, listening to this, summarize the key takeaways? Feels like a win on multiple fronts.
I think triple victory is a fair way to put it for Q2. First, solid profit growth, especially when you normalize it, that 30% core growth is key.
Right.
Second, improving asset quality stability, capped off by finally zeroing out that legacy SR book risk. That's huge.
A big cleanup milestone.
And third, really significant strategic validation. You've got SMBC coming in with a massive 24% stake, and the rating agencies lifting them to AA-, their best rating since the crisis.
So looking ahead, what are the main levers they need to pull to reach that 1% ROA target?
Management seems focused on two main things. First, keep pushing NIMs higher, helped by running down those expensive PSL-related balances we discussed.
Replacing expensive funding with cheap retail money.
Exactly. And second, keep driving profitable retail loan growth, like that 20% jump in disbursements we saw this quarter. That's where the margin and growth seem to be.
Seems like a clear path forward.
The path looks clearer, yes. The momentum seems positive, but we have to leave you with this final thought to consider.
Okay.
No matter how good the quarterly numbers look, no matter how clean the balance sheet seems today, the big shadow remaining is that Supreme Court hearing on October 29th.
The AT1 bond case.
Yes. The final verdict in that case, whichever way it goes, will be incredibly significant. It will either solidify the bank's current standing regarding regulatory risk or potentially challenge it. It's really the ultimate test of how the whole restructuring episode is finally resolved from a legal and regulatory standpoint.
So keep a very close eye on that date, October 29, 2025. It could be pivotal for Wise Bank's long-term stability narrative.